Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll sprinkle in my financial opinions as we go. And it'll be commodity related, financial topics, and or wealth building, as those are the areas that I like to cover. And I think that's where the value's at. So let's dive in here. Let's take a look and see what people are sharing on social media. If you want to follow me at finding_finance, or you can join our community, finding-value.com. We are running a training session at 8 a.m. today. If you're interested, sign up. We have a discount in the description link below, and you can go on Zoom and we can go over all of the information on my strategies and approach in the market, and you can ask me questions directly. So, Ian says, if you had to hold one sector for 10 years, which one would it be? Well, in 2020, when I made that decision, I purchased a bunch of energy, oil and gas exploration, energy service, and uranium stocks. So they're all commodity related stocks. So if it was one sector, it would be commodities for 10 years from 2020 to 2030. And that is where I'm at. That is where I have the bulk of my investment money is all tied up in different sectors of commodities across physical metals, which I'll never sell physical metals. I'll swap them into different metals to accumulate more metals using ratios. And that's what I do to accumulate even more gold, I guess, in the end. But yeah, that's where I would be, physical metals and commodities. Here's GLD, 12 years in the making, and this is one of the reasons why I would be in gold or physical metals. That is a cup and handle, boys and girls. Since 2011, we created this gigantic cup, and then we've got a handle, and we are breaking that to the upside. The projected move, you can see, is this arrow that he's got. He's got an arrow of the cup and the projected move, and it's off the chart. This will have profound impacts on some companies that are high cost producers and some exploration companies that have the goods in the ground. We could see monster moves, bigger moves than from 2000 to 2011 in the gold and silver mining companies. And the reason I think that is because XAU, the gold and silver mining companies, have never been priced cheaper against gold than they are today, at least over the last 30, 40 years. I don't know what they were at the bottom in the 1960s and 70s, but that's what it's been like since 1990s and forward. Bernie Sanders has said, corporate greed is Mark Zuckerberg becoming 3.4 billion richer today while building a 100 million mansion in Hawaii with 30 bathrooms and an underground bunker. Meanwhile, a record-breaking 653,000 Americans are homeless and 60% live paycheck to paycheck. I don't see how that has any impact on these people. I don't see the connection here, guys. Mark Zuckerberg employs a whole bunch of people, and he created a company that these 653,000 Americans could not do. He created the company and has all these people that he employs at the company. People are handing money over to Mark Zuckerberg to create this company in a win-win situation. There's no collusion here. There's nothing bad occurring where he's making his money in a unethical way from a free market perspective. So the ones who solve the biggest problems in the world become the richest. That seems quite justifiable to me. And now people are just going to talk about the extent that people get wealthy. You know, the extent of that is too much. Well, I mean, if one of the 653,000 Americans that are homeless comes up with a solution to the biggest problems in the world, they will be rewarded handsomely. If someone figures out how to cure cancer, if someone figures out how to extend the telomeres on your genetic DNA, they're going to be billionaires. That is the reward for solving the world's most difficult problems. Um, I'm not saying that the smartest people are going to necessarily make the most amount of money, but those who take the risk and those who solve the biggest problems are the ones who generally are the wealthiest in the world. So I don't see I don't see another way to set up the world where people are going to solve the toughest problems in the world and not be rewarded at all for it. I don't know how that would work. Bernie is living in a land that doesn't exist. And if anything, the people who add the least amount of value and make the most amount of money are all government politicians, much like Bernie Sanders. So, in fact, since Mark has created all this value in the free market, I would say that Bernie is probably one of the least valuable people in terms of the uh, job job market. I mean, he's adding the least amount of value because all he's doing is going around saying, "Well, this guy shouldn't make this." Well, says who? He's not the market. So Bernie, just shut up and sit down. Neil, almost time. He says we've got the double bottom here. A lot of the times you get a sell off, you get a kind of a bounce here. You draw a trend line underneath these two guys, which will usually coincide with a peak over on the right. This is a double bottom, and it does look like we are at the bottom here of this double bottom. So we'll probably see this move on up at some point out in the future. Spent time talking with relatives over Christmas break, specifically my one uncle, who is a retired trader from Wall Street. He was saying we'll see the 10-year rally back to 4.1% early January, which will coincide with one of the nastiest rug pulls on the NASDAQ since the dot-com bust. Well, that's his opinion. I do think that we could go down a little bit further in rates before heading higher. I don't know if it's going to be early January, but you know what? Anything's possible, and that could be the case. But that would be a bounce off of some support level, I would think. And I think we're going to get down to like probably 3.4, 3.5 on the 10-year before that bounce will occur. That's my guess. I don't know the time frame. If you think it's bullish that the 10-year yield has fallen from 5% down to 3.7 in just 2 months, then you're mistaken. The bond market wouldn't be doing this unless they saw something coming. This isn't about rate cuts, it's about slower growth. Could be the case. Very well could be the case that we are entering a slowdown period. The only thing that would confuse me is if we're entering a slowdown period about slower growth, then why aren't we seeing copper go down? Why aren't we seeing iron ore go down? Why aren't we seeing some of these other base metals like aluminum go down? Why are diversified mining companies breaking to the upside? Why are copper companies breaking to the upside and iron ore and steel? I'm basically seeing everything break to the upside. So I think that if someone were to ask me the question, are the rate cuts politically motivated at this time? I would say probably. That's probably my case with where everything is breaking to the upside. Now, if everything was breaking to the downside and we were moving lower and we were setting up large topping patterns, then I would say that's his viewpoint is probably right. But since everything's breaking to the upside and the markets are positioning for much higher moves in a lot of things that are economically driven, I'd have to say that slower growth may already be behind us. I don't know. It's tough to say. And it may be politically driven. We'll find out here over the next 6 months which one it is. Accidentally retired, 10K, 50K, 150K, 500, 1 mil, 5 mil. What amount of money would actually change your life? And I think when I think of changing my life, I'm going to put the first change that occurred with me is if you can settle down, if you can buy a home, get a fixed rate mortgage that's at a low payment, and you start saving money, you basically lock in as much as you can the costs side of the equation. Then you start ramping up your income and your savings. I think it's the amount of money that's enough money where you're not forced to do things that you don't want to do. And that's the first stage. So I don't know what that is for everyone. For me, I would say it feels like maybe 500,000 is probably a good chunk outside of your retirement accounts. So 500K would give you enough leeway, 400, 500K, something in that range, I would guess, is enough leeway to say, you know what, I don't want to do this job anymore. If you got 500K and you're getting a 10% dividend yield on 300,000, that's $30,000. If you've locked in your costs, that can probably cover all your costs from the basic necessities. It means that you may not need a $100,000 a year job. And if you don't like the $100,000 a year job, you can say, go screw yourself. I'm going to go get something for 60 or 70,000. That's a lot less stressful. And you've got 30,000 from dividend income. And I think you can do that with 3, 4, 500,000 outside of retirement accounts. And that doesn't mean that you have to put all that money in dividend investments. But, if you've got 500,000, there's ways to make, a 10, 15% dividend yield on a group of stocks. So if you've got 500,000 and 10% is 50,000, 20% is 100,000. So it could easily be somewhere between 50 and $100,000 in commodity stocks that are beaten to a pulp to the downside and basing patterns that are paying out 10 to 20% dividend yields that are ready to break to the upside. Obviously, they're going to fluctuate with the price of the commodity, but that's a good thing if you're in a gigantic bull market. If you're in a bull market, then your $50,000 dividend could easily triple or quadruple over the commodity bull run, giving you even further dividend income. And that's exactly how I'm setting up my portfolio. So I've got a good chunk outside of my retirement accounts. I'm playing the dividend game. And I really don't have to add anything more to my retirement accounts if I didn't have to. And I've got dividends coming in now that are pretty healthy. And it's like, I don't really have to do all that much to continue to cover my costs if I lock in my costs at a really low rate. So the key here is the amount of money to change your life will depend on how well you set up the expenses side on your liability expenses. And then on the income side, how you navigate and set that up. And the best thing to do is to obviously oversave, overinvest, or be on the more conservative side. And you can also have a variety of investments too. You don't have to put it all in commodities or all in higher risk stuff. You can do a good chunk into bonds if you want. Now, I'm not doing that, but you can buy a bunch of high dividend paying oil companies, energy service, miners. There's a whole bunch of stuff that you can do. Tankers and shipping companies. So I would say 500,000 outside of a retirement account is probably the threshold there, somewhere between 150 and 500. Yep, there's me. I did a interview with Bobby if you guys want to know. 71% of advisors have less than 1% exposure to gold. A lot of these people are going to get left behind if commodities enter a super cycle. You dang right they're going to get left behind. Did you guys see that cup and handle pattern? It's freaking awesome. 71% of advisors have less than 1% gold. I'm over in the camp. I've got more than 10%, not gold, but of physical metals. And yes, I guess I am crazy, but I don't know how someone could ride through the downturn in bonds and still be bullish on bonds right now. I mean, yeah, we're going to get a bounce here. I get it. But think longer term, gold and silver and platinum and all the rest, that's the spot to be, in my opinion. But again, that's just, everyone's got an opinion. And sometimes they stink. You know what I'm saying? Market expectations for Fed funds rate path. So they've got a pause in January, and then they go to 25 basis point cuts all the way down, starting in March, May, June, July, and additional cuts out into December of 2025. So that's what it looks like physically. Is there a problem in the market? I'm sure this is wrong. I think if we get a slowdown, they're probably going to drop it more than 25 basis points. They're going to drop it like a rock. That's going to be your signal that a potential slowdown is here. But that's what it looks like right now, and that's the expectations for the Fed funds rate. It's official. One of the least noticed macro moves in a very long time. Gold just reached record levels today. If you ask me, this is the beginning of a move, not the end of one. And here we go, baby. Let's rip this thing on gold. I want to see silver just, rip. I mean, I want to see like 25 to 30 bucks in like a heartbeat. Just boom, like just laying down the rubber as this thing takes off from the trend line, the downtrend line, and bust through it and go. So I'm excited. I think it's going to occur. These rate cuts are a tailwind behind gold and silver and platinum. We just saw platinum rip at about 3.3% or whatever it was today, 30 something bucks an ounce. I am positioned for silver and platinum to run. If they run, that will be life-changing money to be to be gained there. So hopefully it occurs. Hopefully it occurs. It says, don't look now, but Dr. Copper is almost $4 a pound. If we're having a recession or about to enter a recession, copper hasn't gotten the memo. What's the baseline price if demand doesn't collapse and supply continues having challenges? $5 or $6 a pound? I don't think so. I think we're going to 10. I think we're going to like $8 or $10 a pound, guys, because I just don't see how we're going to slow. I mean, we're literally going to have to price out demand. That's where it's going to come down to. And how bad is supply going to get hit? And this is going to get funky, guys. So another way that you can play this. All right, I've got a bunch of diversified mining companies that have all these base metals. They're paying 8% dividends today. Can you imagine what the dividends will be if copper goes to $8 a pound? I'm going to get paid to sit in these companies and do absolutely nothing with them. It is such an opportunity to get in there, get these companies, sit in them, and just let them pay you. It's so awesome. Sorry, I love investing, guys. U.S. home prices hit new all-time highs in October, while affordability has plummeted to record lows. What does this mean? Well, if affordability is going down and your prices continue to go up, it means you have a shortage. That is what it is, guys. You have a shortage. Now it takes dealerships 3 weeks longer to sell an electric vehicle than a gasoline vehicle. Well, yeah, guys, an electric vehicle is good if you just go from like work and back. But if you have to travel across country, I don't know. I don't know if the electrical grid, like the infrastructure for electricity charging is in place, and if the batteries are if they can charge fast enough. So I would probably still just drive my gas powered cars, which I already own them. And I have no plans of buying an electric vehicle unless they can figure out how to charge them very quickly, make it a lot more convenient, then I would think about it. Or if gas went through the roof, it'd have to go a lot higher. But I don't drive a lot right now, so I'm kind of cool with just not doing anything. It says, we've hit uranium thesis on CNBC stage of the cycle. Is this a signpost you'd see in the middle of any great bull market, or the type of contra indicator you see near a top? I think it's the middle of the bull market. We're getting media attention phase. You can't make this up. The market is now pricing in a base case of 7 interest rate cuts in 2024. There's even a 10% chance of 8 rate cuts in 2024 with a 1% chance of 9 rate cuts. In other words, the markets are saying there's a possibility of up to 3 times as many rate cuts. That's crazy. Silver here, gold breaking to all-time highs, and everyone is wondering why silver isn't moving. It will, and it will happen fast. Expect a rocket out of this downtrend at literally any moment for the silver squeeze that's ready to occur. What I see here is I see a resistance trend line. We hit it, came on back. We hit it again, came back. And then we came up and we're hitting it. We almost came up and hit it again. We're starting to hit it more frequent and we're not pulling back as far. That means you're getting very close. You can see here, here, here. We're walking right up into that resistance line. We're going to rip this thing, a new one here very soon, when gold starts going up into all-time highs. So it's just a matter of time, guys. And the way I view this, position now, get in, hold on, and just ride this bull. Ride this bull, guys. It's going to be fast. And maybe it only lasts 6 months to a year of this bull market where it rips. Maybe it gets to $50, $100, $200 maybe. Who knows? Who knows where this thing will ultimately stop? I think it's going to. I'm going to remain very optimistic on silver, and I think it could go up a lot. We'll see what it turns out to be. Here's another one. Let's go over this real quick. I've worked in finance for 6+ years. I've spent over 4,000 hours on spaces discussing investing with experts. 99% of investment advice can be boiled down to these 21 sentences. Here's 99% of investment advice. Knowing a little about 50 companies won't make you money, but knowing a lot about 5 companies will. If you want to get rich, invest with weeks in mind. If you want to build wealth, invest with decades in mind. Your time frame needs to be longer. Thousands of people try to predict the stock market. One of them will eventually be right. This doesn't mean they knew it. Investing is 10% buying and 90% patience. I totally agree with that. Losing money investing hurts more than making money investing. Remember this when you take risks. If you're starting from little or nothing, build an emergency fund first before starting to invest. Totally agree. Picking stocks is fun, but you'll probably lose money. 90% of the people are better off focusing on indexes like the S&P and total stock market. Personal finance is greater than investing. Prioritize financial literacy over just learning how to invest. The stock market's movement shouldn't determine your investment strategy. Pick a plan and stick to it. The stock market has averaged 10% a year over its history. Don't worry about the short term. I do. I don't worry about it. I take advantage of short-term weakness to buy more. Don't put more than 5% of your portfolio in a single stock. That makes sense. That's portfolio allocation. Risk comes from not knowing what you're doing. A falling stock price is not a good reason to sell. Focus on the business, not its market movement. It doesn't matter if you own index funds or individual stocks. If you don't control your emotions, you still lose money. Bull and bear markets both call for celebration. There's opportunity in everything. Rebalance when small positions increase or decrease by 25%. Rebalance when large positions increase or decrease by 5%. If you need money in less than 3 years, don't invest it. If you need it in 3 to 10 years, don't invest it in 100% stocks. If it's any time frame above that, invest however you want. You'll never be able to remove your emotions from investing, but this doesn't mean you can't control them. If you want bonds in your portfolio, invest the difference of 120. Your age, it's 120 minus your age in stocks and the rest in bonds. Stocks are short-term risky, but long-term safe. Bonds are short-term safe, but long-term risky. Yeah, I would say the first. Bonds are a lot more risky than what most people think. That's all I'm going to say. Volatility and uncertainty are the price you pay for high investment returns. It's always worth paying. I agree with that. Volatility is massive in these high investment returning stocks. You have to live with that volatility. You have to harden your conviction And that's where I'm going to end it, guys. That's what I've got for today. So give me a thumb up for the content. Subscribe to the channel. We're running a training session coming up at 8 a.m. Don't forget about it. This is on Thursday, 8 a.m., and that's on the website. Discounts in the description link below. It's going to be covering my investment strategy, going over the 3 pillars, being able to, how I'm able to identify really good value and good entry points, portfolio position size, risk. I'm going to cover as much as I can in the time that we've got. It's going to be a lot of information in a short time frame. So get ready, be ready for it, and hopefully you guys walk away from the meeting with a little bit more conviction, a little bit better strategy if you implement any of it, and a little bit better idea of how I'm picking my companies. So that's what I've got for today, guys. We'll catch you next time. This is Finding Value.